Good morning, everyone. Nick's just given you a fairly high-level view of the global positioning of Australia, and I think you'll all agree that Australia has been well placed in a global context in the last 2 to 3 years. I'm going to give you a bit more of a dive into the Australian market drivers as a prelude to a panel segment where we'll ask some key questions around specifics that we're seeing within the leasing and capital markets. But to start with, I thought I'd give some context to where we'd been. Really, over the last 10 years, we've seen 3 key phases within the Australian property markets. Obviously, we saw the unsustainable expectations phase, which really led yields down to very low levels based on unsustainable growth expectations and high levels of leverage. That has worked itself out over the subsequent 5 years. We saw the key difference being higher risk premiums globally across all asset classes, including real estate. And I think we've moved more into a phase where things feel a bit more balanced now. So while we have some forces wanting to push yields up, we have some forces wanting to push them down. A key factor has been the improvement in risk premiums that we've seen in markets such as the equity market and in the debt markets over the last year. However, we have had a challenging occupier market, which has offset that. But that's played out in prime yield compression. You can see there across all sectors. We've seen between 9 to 14 basis point compression across prime assets. I think a key factor to consider about valuations is what drives them in terms of what's the source of capital and what's the value that the market places on that capital at points in time. And a long-term view is that valuations can't get too far out of line with the underlying source of capital. The light green line there is household savings. That is the fundamental source of debt and equity capital in the Australian marketplace. And you can see that these things in the long term tend to follow each other, but you do get points of deviation. The major one was in the early 2000s. So things like prime office yields and equity market valuations moved to, again, I say unsustainably low levels based on high levels of leverage and high levels of growth expectations, which couldn't be backed up by the underlying pool of capital. The key point here is things look a lot more balanced now. We do have a strong growth in capital stock in Australia, but valuations now look more in line with that. And you could apply that concept across a lot of markets. The key difference has been the shift in the funding mix for balance sheets. You can see across the business sector and the household sector, pre-GFC, post-GFC, equity funding is now a much more significant part of our market. And in that type of condition, you tend to see fairly conservative pricing in terms of asset yields to support returns on equity. That's a fundamental shift. And we don't really see that changing given the economic outlook, which we'll get to over the next year. If you look at commercial markets here, we have seen an increase in transaction values over the last 2 to 3 years, and particularly strong last 12 months, with domestic funds very active, 33% increase in the value of transactions. Foreign players are still a significant part of the market, although activity declined last year. There's a key difference there between value and number. So the number of transactions has actually been quite flat, whereas the value's a lot higher. So it really supports the notion that we're seeing much more activity in prime, in large property. There's not as much depth in the market now as there has been in the past. And that's really consistent with that prime versus secondary story that we'll get to. If you look at Australia at large, a feature of the last 3 years has been very strong foreign direct investment flow. That's quite important. That's a more stable medium to long-term source of funding for the Australian economy. A lot of that's come into the mining sector, but as you can see in the chart on the right, a lot of that's come into the commercial property sector as well. In fact, the net exposure of the foreign investor sector has increased by $11 billion since 2007. And before the GFC, the sector was effectively buying and selling between itself, wasn't increasing its net exposure. So there is a lot more capital that's in direct investments in Australia now, and as I said, it's a more stable source of funding than the types of portfolio flows, which is the light green line on the left-hand chart. They're the sorts of shorter term flows that can disappear quite quickly. Obviously, the question is, will this change given what's happened in the economy? Lower interest rates have been, I think, the catalyst for the fall in the Australian dollar. You'll notice there the terms of trade is a key long-term driver of the Australian dollar. That really seems to be at a structurally high level now. So I think the longer-term average for the Australian dollar looks higher than it was before, which the 75 cents is the old long-term average. The new long-term average is somewhere between 85 and 90. But we'll still be subject to these cyclical shifts as interest rates move. And you can see there that while interest rates have fallen recently in Australia, we're still slightly above long-term average. So we're still getting a reasonable amount of support from that yield differential perspective. But the reason rates are coming down is because the economic outlook is quite mixed. That's the factor that's key for the tenant markets in Australia. There has been, the circled area shows the divergence in growth that we've seen over the last 3 years off the back of the engineering construction boom. Those two lines rarely deviated before 3 years ago, but you can see that what was holding the headline GDP numbers up last year was a lot of mining investment. What's going to pull the headline numbers down this year and going into 2014 will be the runoff in the mining investment. There's still a lot of activity happening, it's just not as much as last year. So GDP looks like it's going to slip below 2% later this year and into 2014. We suspect that with the rate moves in place that consumer and dwelling activity will accelerate from what's currently quite a modest pace of recovery. That's critical in our assumption for the market. But we do think we'll be below trend growth for the next 2 years and we'll get back to trend in around 2016. So there's a couple of years where we're going to go through a similar environment, I think, to what we've seen in the last two, although the mix will be different. If you look at what that environment has meant for business, obviously sales growth has been soft across all of the sectors, industrial, office and retail, much softer than long-term averages, even in the last year much softer than the post-GFC average. So the last year has felt pretty tough if you're an occupier. And they've had to work hard to manage margins. You can see retailers have retained margins. Office occupying industries have increased margins, so that's banks. Banks can increase margins. Industrial margins have been under pressure though. It's quite a mixed bag in industrial. Manufacturing is really the one that's dragging that down, whereas transport and logistics is actually looking a bit better. But that's been a tough environment, and it's one where business has really had to focus on labour and real estate efficiency. So it's not surprising in that environment that we have seen a fall in full-time employment across each sector, or very low rate of growth in industrial. And that's really what's dictating the sentiment in the commercial property markets currently. So not surprising that we have seen rental growth soften in the last 12 months. If you look at effective rents in retail, down 3%, effective rents in office down 7% year on year to June. Industrial still up 2%, although the last 2 quarters have been flat. So things in terms of rents are slowing in 2013. And given that economic outlook, you'd expect that will continue over the next at least 12 months before the economy starts to turn the corner. If you look specifically by sector, office demand looks like this year will be the trough. The big thing we've lost this year was the kick that Brisbane and Perth had given us. And as that sort of mining support services story unwinds in Perth, and you're seeing a halving in net absorption in that market, that's really pulled us back to look a bit more like the flat growth that we've seen in Sydney over the last 5 years. If we're right on the economy, we should see a modest improvement in that going forward, although it's not getting back to the levels that we've seen. So it's a fairly subdued outlook in terms of demand. We have put the supply numbers that are coming onto the market against that. So I guess not surprisingly, vacancy rates are expected to increase across the major CBD markets in the foreseeable future. The peak vacancy is probably the one to focus on there. For Sydney, that will obviously be 2015-16 as Barangaroo completes. But most of the market, and Perth has some supply coming on in 2015, as does Brisbane. So look, the peaks there, with one exception, are within historical ranges that we have seen. So they're not by themselves a concern because long-term investors expect vacancy rates to fluctuate through the economic cycle. The one that's probably getting closer to above its long-term, that sort of range of trading, is Brisbane. That peak of 14% is probably looking the highest and above its the sort of normal levels that we've seen over the last 15 or so years. The key factor, obviously, is what's shifted in terms of office demand. The public sector has been a big influence on Brisbane. You can see there it's about 37% of CBD employment. It's contributed about 300,000 square metres of growth over the last decade. It was a key reason for the improved performance of that market over the last decade relative to the previous decade. But government's been a big contributor across a number of other markets as well, which mightn't be getting as much focus. But government is likely to consolidate and is likely to tighten. So we wouldn't expect the performance of the last decade to continue in terms of the government contribution to growth. May well look more like the 90s. For Sydney, it's interesting. Sydney hasn't had much of a kick from government over the last 2 decades. Obviously, this is looking at CBD. The government in Sydney is more decentralised. So probably less of an impact from what I'm telling you here on the Sydney market. Finance and business services is critical for Sydney. That's been the soft point relative to other markets. I think the other market worth pointing out is Perth, which saw basically a doubling in net absorption from finance and business services. It was essentially supporting mining. You'd expect that market might look more like the 90s going forward over the next decade. So that'll be a critical shift. The terms of trade. What does the terms of trade have to do with commercial property? I often get asked. The terms of trade actually gives us a view of the value of what we produce in Australia versus the value of what's produced elsewhere in the world. If the terms of trade goes up, what we have is more valuable. So everything that produces that is, in theory, more valuable. Now, the concentration of that impact being largely the result of resources exports has been quite significant in Perth, which I put up there. So if you actually benchmark the Western Australian economy versus office space as an index, you can see there's been quite a jump in the value of what's produced in WA versus the value of the input real estate. So it's not surprising that you have seen the strongest rental growth performances in markets like Perth and Brisbane. Why am I telling you this? The terms of trade is now coming off, so that one-off impact has happened. I don't think the terms of trade are going back to where they were in the 90s, but that extra boost that some of our markets have had from the terms of trade will dissipate. So you expect a bit more normalisation and a bit more of a rebalancing in growth domestically as a result of this. So what's the outlook for rents? Obviously, net effective rents are weak this year. We expect they might stabilise a little next year, but still overall soft. Industrial rents have been stronger than their long-term averages. We do think they'll soften in line with the economy over the next year, so slowing, not as soft as the other sectors. Retail, slow this year. As I said, we expect consumer to be one of the factors that drives the economy in 2014, 2015. That should see the rents bottom in retail and start to improve marginally in 2014. So look, let's look at yields now. That's the subdued occupier story. Let's talk about yields. It's the balancing act. How will it play out? So the factors wanting to push yields down, things like relative returns or required returns, funds reallocating from cash back into high yield assets. We've seen some of that this year. Falling risk premiums and lower funding costs. They're working to push yields down. We seem to have seen that pan out in prime. But there's a number of factors looking to push yields higher as well. Slower growth, which I've obviously spoken about. Bond yields stabilising, potentially moving higher globally and in Australia. And look, lower leverage, which I mentioned up front. While it may improve, it's not looking like the sort of levels that would drive significant yield compression. So it really depends on the asset, where the yields are. What we've seen historically is that the less than prime asset classes have been the sort of outlet valve for those factors wanting to push yields up. They're the risk factors. You've seen that across office markets, across industrial markets, and within retail as well. So you've seen the spreads between the prime end and the secondary end widen over the last 3 years. That's probably likely to continue given the growth outlook. But yield drivers are diverging. If you look at bond rates, last year we're probably supporting compression, the green arrow down. This year, stabilising, maybe wanting to push yields up. So that's one offsetting factor. The key thing there is the risk-free assumption that valuers would be using on property. So I think you're reaching a point where that's near its bottom now, and that will be, I guess, reinforced by higher actual bond yields going forward. On the other hand, if you look at risk premiums, we look at corporate bond borrowing costs over government bonds. Risk premiums have come down quite significantly this year. They were also supporting yield compression by over 100 points for BBB. We expect that'll probably continue, but not at the same rate it did last year, because we don't think risk premiums will actually get back to where they were before the GFC, the unsustainable expectation phase. The final part of the puzzle is rent growth. So looking at net face rent growth for office versus its long-term average. Last year we saw a slowing, which I've spoken about. That wanted to push yields up. We think we'll see the same for the next 6 months at least before we get some stabilisation in expectations. So at best that'll be a neutral factor. So probably the factors that wanted to push yields down last year are, on balance, a little less strong in the year ahead within the Australian market. Now, if I can just focus briefly on I've spoken a lot about the domestic side, indulge in one international comparison. The investment markets, the question here is, are we at a discount to global, or has global gone too far? And I'm not going to answer that. But I think it's fair to say that Australia's markets, if you look across bonds, equities and property, a fairly conservative valuation is probably not a bad position to be in if yields do back up globally. There's a bit of a cushion there. We haven't followed them down. To the extent that yields globally in bond markets and property markets and also equity markets have been inflated by the QE program in the US, we're probably less exposed to that because our pricing has been more conservative. So that could go either way, but I think a key thing here is we've had stronger growth. You can see there the average growth. I'm comparing to Canada because it's a similar economy. It's always been a favourite pastime to compare Canada and Australia. Currencies follow each other, bond markets follow each other. We've had stronger growth, hence we've had higher interest rates. It's actually a fundamentally stronger position to be in, and we do have reasonably conservative valuation. So in terms of the outlook, obviously I think from what I've said it's quite clear the occupier market's likely to be challenged going into 2014 with a softer economy. We may see some improvement later in 2014, which we'll see through consumer, and we'd expect that would start to support some modest improvement in rental growth in the retail sector. Overall, the indicators for yields, though, pointing to some stabilisation. That's that change in mix that we just spoke about, with lower rental growth and potentially higher bond yields. But I think in that environment, you're still going to be looking at prime outperforming. There's still caution and leasing risk, which will hold back the secondary markets. And beyond 2014, I think you can start talking about, as confidence and growth expectations start to improve, that's where we can start talking about broader compression in yields across all asset classes.